Hi, everyone, and welcome to episode number 9 of The Bottom Line. As always, I'm your host, Deepak, and I'm joined by my co host, Syed. Just to quickly go over the agenda for this week, Syed will be providing a quick tech update. We're going to be talking about Spotify's decision to let its employees work from anywhere in the world. We're going to give a quick portfolio update from both Syed and myself, and we're going to end off the episode talking about trading tips for beginners because I know this week when we had a lot of market weakness, some new traders didn't really know how to manage their trades. So I felt it was important to address this week so that we ensure that if there is more volatility in the coming weeks, that the beginning traders are aware of the tools that they have at their disposal to manage risk. So with that being said, I'm going to pass it off to Syed, who will kick it off with his tech update.
Thank you, Deepak. I hope everyone's staying safe and healthy. In regards to tech and InfoSec, there are a few things that I wanted to go through that happened this past week. So to start off, I wanted to let our viewers know that Lakehead University in Thunder Bay, they remain offline after they suffered a cyber attack. And in response to the attack, their officials shut down all computer systems at their Thunder Bay and Aurelia campuses. The message sent to the faculty members and students doesn't say how the threat actors managed to infiltrate the information systems of the university. It just says that their systems are down. So all of Lakehead's data and servers, including access to its website, have been offline since February 16th. Online events such as 2 virtual tours of their campuses were also postponed. So I think that they suffered a distributed denial of service attack, but that's what it seems like here. That's essentially when a system gets a flood of packets and it can't handle them, and the system gets overwhelmed, the network gets overwhelmed, and it just stops working. So that's what it is at a very high level, and I'm pretty sure that's what happened here, but just something to keep an eye on. And I just wanted to let our viewers know that these bad guys, these hackers can they also have like these universities and colleges and post-secondary institutions on their radar too, and no one's safe from them. So it's important to have mitigations in place. Moving on now, I wanted to also mention that the Canada Revenue Agency suspended online accounts of over 100,000 Canadians after login credentials were found for sale on the dark web. And essentially, I just wanted to make our viewers aware that if you received an unexpected and cryptic email on February 16th from the CRA warning that your email had been deleted from the agency's web platform, My CRA, essentially don't worry, your account hasn't been breached. In fact, the agency said it means that their new early cybersecurity issue detection system is working. So just wanted to point that out there. But one thing that like an article here mentioned, and I will put this article in the description, is that this could also mean that your login data has probably been compromised through a third-party breach, and you will need to contact the Canada Revenue Agency in order to regain access to your online account, particularly if you plan on filing your 2020 taxes online starting next week. So again, link to the article is in the description, so be sure to check that out. And if you need to contact the CRA, be sure to do that. Moving on, I know since we started the bottom line, Deepak and myself have mentioned Solarwinds a lot, and obviously so because of what happened with their breach and stuff. But I saw another article that came out regarding Solarwinds this past weekend. It essentially said that the Solarwinds attack hit 100 companies and it took months of planning, says the White House. So this article basically has a nice read, and it basically says that the White House warns that Solarwinds attack was more than an espionage because the 5 private sector targets could lead to follow-up attacks. So it just goes to show that, like, and I mentioned this last week too, that the Solarwinds hack is gonna be something that everyone's gonna be talking about for the foreseeable future because it was major. And the article just says that the White House team leading the investigations into the hack is worried that the breach of 100 U.S. companies has the potential to make the initial compromise a headache in the future. So a good article to read. Again, link will be in the description. And lastly, to wrap up the tech update, I wanted to mention Discord. And there's an article on Cyber Social, again, link in the description, that basically says that Discord is a new paradise for cyber crimes. Now, I know that the gamers use Discord, and many of our subscribers and viewers are gamers. So wanted to put this one out for you guys. But not only gamers now, due to the pandemic, as we saw with Zoom, Discord has become a major thing for just chatting, calling, video calling, etc. So a lot of people are on it now, not just gamers, but like just normal people that don't game. So they just use it for their daily communication and stuff like that. So I wanted to point out that people of all ages turned online for school and work to stream videos and play video games, and they basically have a virtual get-together and engage in many other activities on Discord. And cyber criminals know this, and they took note of this and launched new campaigns targeting online users and gamers as well. So one thing that many of these campaigns share in common is the fact that cyber criminals have begun leveraging the group chatting platform Discord as a platform for hosting their malicious payloads. Now, what is a payload? I'm not going to get too in depth into it, but a payload is essentially the foundation of a virus or malware, and these payloads are sent as a link to you, and you as a victim would click on it, and your computer or your device would get infected with this malware or virus. So you don't want that to happen. And I know that like many of us use Discord, so I just wanted to point that out there to keep everyone safe, our viewers safe. So be sure to keep an eye out on that. Don't click on anything. Like I always say, phishing is a major thing to keep an eye out on, and don't click on links that not without knowing what it exactly is. Okay guys, so that was it for the tech update. Be sure to check out the links of those articles in the description. Moving on now, I wanted to talk about Spotify and how they're jumping on the remote bandwagon in a huge way. As this past Friday, they announced that they're gonna let their employees choose where they'd like to work from. So geography won't matter in a sense. They could be anywhere in the world, those Spotify employees, and Spotify will let them work remotely from that specific location. I wanted to bring this up because it's like there must be like a few roadblocks in this because I always wonder with the pandemic and post-pandemic, right? Will all companies allow this? We are going to see a change in companies allowing employees to work from home, but what Spotify has done here is a major change in the game, and I'm sure there's roadblocks from this for every company to implement this. But I wanted to ask you, Deepak, what are some roadblocks for every company potentially going towards this, allowing their employees to work from anywhere in the world?
Yeah, so I just wanted to start off by saying, like, I don't think this work from home trend will actually end, right? Like, I think we're going to have a hybrid model where employees will probably have to work out of the office, maybe let's say 3 times a week instead of 5 times, right? Like, I think overall density at the offices is going to decline because before it seemed like everyone was jam packed into small, compact office space. Now, I think with social distancing, I don't think that'll happen. And even as we transition away from the pandemic, I do think all employers are going to give employees the flexibility to work from home at least maybe twice a week, maybe even 3 times a week. Now, with that being said, if you think about letting an employee work from anywhere across the world, like let's say you were working in Los Angeles and now they tell you, okay, you can work from anywhere. So employee A goes back home, his family's in New York, let's say, right? And employee B's family is in like Oklahoma City. Now, they're both still being paid the same amount of money, but one person's cost of living, employee A's cost of living, is far greater than employee B's cost of living. So I don't necessarily think that's an equitable result. Now, I think these companies, what they're going to have to do, and I think there's rumblings about this as well, is they're probably going to have to look at adjusting earnings based on where they're going to be working out of. So obviously, they're going to have information about where their employees are working from, right? Like that's going to be information that an employee will have to provide to their employer. So I think based on that, the cost of living will have to be adjusted from their wages if they are to pursue this. So I don't think it's going to be as clean cut as like, okay, this both employees are currently making $60,000. They can work from anywhere and they'll still be paid $60,000. I think they'll have to adjust it according to where the employee wishes to work from. And until they can do that, I think there's going to be a lot of barriers to this. So, I mean, yeah, like I think there's a lot of kinks to iron out here before it can actually get formalized where all the major companies are doing this. But is it out of the question? No, I don't think so. But there's still a lot of work that needs to be done before every single employer switches to this sort of model.
Yeah, cost of living is something to look at, like you mentioned, because specific locations around the world, say for example the Bay Area, right? San Francisco has a higher cost of living than say like you mentioned Oklahoma City or even like another city in the United States or across the world. So I'm actually I'm surprised. Like I want to see how Spotify is going to manage this. It's going to be interesting to see, definitely, but it's definitely a step into something new. And sticking to Spotify, I also wanted to mention that their stock was actually up last week, as just on Friday it was up 2.74%, almost up $9 at 364 $59 per share. And I wanted to I brought up Spotify and stocks in general. And so far on all of our episodes, we've been giving like stocks to look out for, and now of course you got to do your due diligence and all that. But we haven't really looked into like trading tips and like how to trade and like basically general advice on how trading works. So with that being said, I wanted to ask you, Deepak, do you have any tips for viewers on trading?
Yeah, thanks, Ed. So obviously, we saw a lot of market weakness throughout the week last week, and I feel like a lot of beginning traders were kind of caught off guard and they didn't really know how to manage their trade. So I did want to go over a few concepts that new traders should especially be aware of, just so that they can limit their risk, right? So I want to first start off by differentiating between market orders, limit orders, stop market orders, stop limit orders, and then trailing stop market and trailing stop limit orders. So a market order is what we're used to. You place an order on your account, you do it at market, so whatever the prevailing price is at the time, your order gets filled at that price. The limit order, on the other hand, if you look at a stock, let's say it's trading at $50, you can place a limit order at, let's say, $48. So when you place that order is only going to be triggered when the stock price falls below 48. So if it never hits 48 and it goes from 50 to 52 and just keeps going higher, that order won't fill. So that prevents you really from buying at a top. So if you know that the stock's going up, you want to put a limit order slightly lower so that when it does pull back, you make sure that you're buying at a lower price and you're not buying at a price that you're not comfortable with, which you are on the risk of if you're placing a market order. Similarly with a stop market order, so if I have a profitable position, let's say I want to protect profits because I'm up 1,000, 2,000, 3,000, whatever your profit is, right? If you set a stop market order, let's say the stock price, again, let's use the example of $50. You want to set a stop market order of $45. So that means that if the stock price dips below 45 or it dips to 45, the order gets triggered at the market level. Now, if there's no volatility, this is usually a safe order to place because you'll probably get a price that's very similar to your stop order. But if it's volatile and the stock price, let's say, is dropping very sharply, it might not fill at 45, it might fill at 40. So you have more risk there. That's when you use the stop limit order where, okay, sure, it drops from 50 to 45. But if you have a stop limit order of $45, if the stock drops to 44, the order won't fill. So it'll have to go back up to 45 before it fills. So that's the discrepancy there between a market order and a stop limit order. With the stop limit order, there's also the chance that the stock keeps dropping and your order doesn't fill because you've placed a limit order at 45, but it keeps going from 44 to 43 to 42. So depending on what your goal is, you'll want to adjust accordingly. A similar topic is a trailing stop market and a trailing stop limit order. They're very similar to just a traditional stop market and stop limit order, but when you have a trailing order, basically you can apply either a percentage amount, like let's say it's trading at $50 and you want the stop loss to trigger at 5% down. You can do that. Or you can set a dollar amount, like $5. So if it again dips to 45, then that order will trigger. But the key difference to note with a trailing stop market and a trailing stop limit order is that as the share price continues to rise, that $5 threshold or that 5% threshold will move up along with it. So if the stock price rises from $50 to $55 and you've set a stop limit order at $5, what's going to happen is instead of being from 50 to 45, because the stock price rose to 55, your limit order actually moved up to 50. So that's the difference. So as the trade becomes more and more profitable, that level keeps sliding higher and higher. And that's a good way to protect profits, right? Because if the stock's benefiting and it keeps going higher and higher, you have more profit that you'd want to protect. So by implementing this trailing stop market or a trailing stop limit order, you're sliding up the threshold along with your trade. So you're better able to protect profits that way. The other two things that I wanted to talk about are position sizing and how to scale into a position. So position sizing is very important, especially for someone who's a short-term trader, either a day trader or someone who just doesn't want to hold the stock for too long, right? When you're position sizing, you want to have a target loss amount set. Like this is the maximum you're willing to lose. Like let's say I go into a trade and I'm like, okay, my maximum loss that I'm willing to tolerate is $500, let's say, right? And the current stock price is $50 per share. Looking at the chart, if I know that the next support level for that stock is at $45 a share, I can say, okay, I want to take a position size of 20 shares so that if it drops from $50 to 45, that's a $5 per share drop times 20 shares. So then you're going to reach your target loss, right? So that's basically how you want to set your position size according to the maximum amount of loss that you're willing to take. With regards to scaling into a position, this is more for when I want to take a long-term approach to a stock. Whenever I want to buy something, I go in with a 40% initial buy-in. So if my target position size is $1,000, let's say, I'll only buy $400 to start off with. And then I scale in with a 20% ratio. So like if I see a 15% drop in the share price after I've bought, then I'll buy 20% more. And if it goes down 15% again, I'll buy 20% more until I reach my target goal. If it doesn't come, then that's fine. Then I'm going to stick with my 40% max buy-in. So that's how I scale into a position, and that's also how I scale out of a position. But I think these tools are really important, especially for new investors to be aware of, because they can really help you to A, limit losses, and B, protect profits. And really, the way to win in the stock market is to keep your losses small and your winners large, right? So you need to be aware of these tools when you are in these sort of positions to make sure that if you are in a profitable position, you make sure that you keep some of the profits. And if you are in a losing trade, you don't let it continue to bleed out. You want to limit that loss so that you protect your capital. So I think these tips in general can be very helpful for new traders, and it'll help ensure that they don't really let their capital get away from them. So I think this was really important to discuss here.
Yeah, so I wanted to ask you, as we will discuss crypto trading later on in the episode. I wanted to ask, could these strategies on basing your position apply to the crypto market as well, or is it just general advice for stock market trading?
See, I don't know if these crypto trading platforms have the stop market orders, stop limit orders, or the trailing stop market, trailing stop limit orders. I don't think it has that, but maybe it does depending on your platform. But
Right.
still, position sizing, again, like it's really important. But with crypto, the thing is, you don't have a fixed number of shares to buy, so it's a little bit different to sort of phase in. But again, like scaling into position is always important. Like I said, like if I want to go into Bitcoin, I'll take 40% of my initial target amount to invest. And if it drops 15%, which is entirely possible given the volatility in crypto, then I'll buy another 20%. And if it keeps falling, I'll buy another 20%. But I think a lot of new traders just go heavy on their first shot of buying these stocks or buying these cryptos. And then when it pulls back, they get frustrated and then they panic sell, right? So
Yeah.
you want to avoid that. You don't want to panic sell. But again, you don't want to let a losing position completely run away from you. But you also don't want to buy heavy and then at a pullback, a healthy pullback, you end up selling because it's too big of a loss for you to handle. So these tricks will work regardless of whether it's crypto or whether it's a stock. But um, these are just some prudent tips for someone who's new to trading to just keep in mind to make sure that they're not losing more money than they're comfortable losing.
Yeah, and how do you deal with these tips and also look when you look at like the meme coins or like the meme stocks, how do you apply these tips while looking at all the hype around those meme stocks or coins? Do you have any tips on that?
We'll see. Like as a new investor, I wouldn't recommend just buying into a stock just because of the hype. Like we always
Right,
mention on this channel, like you have to do your own due diligence to make sure you're very convicted, right? So
right.
one of the other things is like people listen to someone on like Twitter, for example, blindly, and you just buy a stock because someone else on Twitter is buying it,
Or
but you
Reddit.
have no idea what the
Yep,
company does, right? Like
yep.
that happens to new traders, and then when it drops, you panic, like what's happening here? But like if you really know what the company's doing, then you're gonna look at that as an opportunity to buy more. Like if I tell you that Apple's gonna drop, if you see Apple drop 10% tomorrow, you'd
Hmm.
probably be inclined to buy it because you know Apple's a very strong company, right?
Yep.
But
Yep.
if a penny stock drops 20% and you have no idea what that penny stock does, you're gonna just take your loss and run away, right? I don't think you'd be comfortable averaging that position. So unless you're very convicted about a stock and you understand what they do fundamentally, I wouldn't recommend just jumping into a hype train, right? And if you do, then these tips still come into play, right? Set your stop losses. Like if I want to buy DogeCoin, my maximum threshold for a loss is $500. Buy accordingly and set your stop losses. If you're at $500 loss, then you just exit that position.
Definitely.
Don't let it go all the way to zero, right?
Yeah.
These are some key things to keep in mind.
Yeah, and you know what doesn't help is like people like big figures like Elon Musk and other people meant hyping on these hype trains, and that doesn't help a new investor either because they'll be like a very well powerful figure that
Yeah.
obviously knows his stuff, right? Tweeted this, so I'm gonna hop on this train and get
Yeah.
Doge or so that doesn't
Yeah.
help either at all, right? But these are some really great points you mentioned. And since you mentioned these points, I want to reiterate the fact that we are not financial advisors, and this is only for educational purposes. So please, 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 always do your due diligence and know your risk tolerance, and use these tips as educational advice.
Yeah, and one final tip is always when you're trading, don't trade more money than you're willing to lose or able to lose, right? Because like I
Yep.
read all these stories on like Reddit where like people lose $100,000, their entire life savings, and now they have no money left, right? Like don't trade money that you're not comfortable losing entirely. So if it means that you're not going to be able to pay your mortgage because you lost $2,000 off the market, like you shouldn't trade that money, right? So you have to make sure that you're comfortable before going into the stock market because again, like it's very volatile and nothing's a sure thing in the stock market. So you have to be comfortable with what you're going in with. You have to be comfortable with your risk tolerance, and that's the importance of position sizing as well to limit your losses.
Yeah, definitely. Yes. Well, thank you for the wonderful insight, Deepak. This really helped me for sure, and also our viewers, as this is some great advice on having a position and basically like knowing what you're doing on the market or even crypto trading. So yeah, thanks for the wonderful insight here. And now we're gonna move on to our portfolio. So for my portfolio, there haven't been many updates, although I did want to mention a few stocks. So the first stock was the Score, and for this stock, I do have a position on it, and I wanted to mention one thing that I noticed with this stock. So this past week, I noticed this stock's price rise to around $50, and I did some research, and it turned out that the Score went through a 10-in-1 reverse split, and I wanted to ask you, Deepak, what exactly is a 10-in-1 reverse split, and what are the benefits of it, and why do companies look towards this?
Yeah, so Syed, so just very quickly, so reverse splits basically, um, the score was trading at around $5 per share before the split. They did a 10-for-1 split, and now they're trading at about 50. So basically, they just combined the value of what 10 shares would be into one share price. So like, if you had um, 50 shares, then they're gonna just reverse that into 5 shares, right? But you're gonna have the same value. It doesn't change the total value of your portfolio or the value of your position size. And it's the same thing with a stock split, right? Like Tesla did a stock split before as
Mm-hmm.
well. If you have like 5 shares and then they do a 1-for-5 split, then you're going to have 25 shares. But the value doesn't really change, right? The reason why someone would do like a stock split, for example, is like in Tesla's case, the stock price went up so high that it was hard for a retail investor to have the money to even buy one share. And Amazon will likely go into this direction as well. I don't know whether they will or not, but I think it's possible in the near future. It just gets like, although it doesn't create any value, it allows people to buy more shares when there's a stock split, for example, right? The reverses are interesting. Like sometimes companies will do it for the purposes of like a Nasdaq listing. Like if they need to meet a certain threshold to get uplisted to the Nasdaq from an OTC market, then they'll do a reverse split just to meet that share price requirement. Um, I'm not too sure why the score decided to do this reverse split, but they did. Regardless of the fact, it doesn't really change the value of the company per se. As an overall company, I think what they do, it's similar to this uptrend. Like there's a bull market in these gaming stocks,
Right.
and like DraftKings, for example,
Mm-hmm.
Gold Nugget is another one. Like I think these stocks are in a bull market, so I think the score will also. I think the price will trend higher. Um, I, I haven't really looked into too much of what was the reasoning behind this reverse split, but I just wanted to reiterate the fact that it doesn't really change the true value of the company, and it doesn't really impact you as a shareholder. You just like you'll have less shares, but you'll still have the same amount invested in the company. So it doesn't create value, it doesn't diminish value, but it's still a tool that these companies utilize. In Tesla's case, to get more retail investors to be able to buy shares. And some smaller companies do it to be able to get uplisted from the OTC markets onto the NASDAQ. So I've seen it in those instances, and that's commonly where it's utilized, I believe.
Yeah, I think for the score they just wanted to raise their stock price per share overall, so I think that's why they went for this split.
Yeah, thanks for your update, side. So on my portfolio side, I haven't. Um, well, see, the thing is with me is I'm seeing a lot of market weakness right now. I know it keeps rebounding when it dips, but um, I don't know. Like the market's looking a little shaky to me, so I have rebalanced my portfolio a little bit. I was in some more riskier positions earlier. I've closed those positions out, and now I'm taking more position sizes in these blue chip stocks like Apple, like Microsoft, J&J. So I'm starting to shift my portfolio into these blue chip companies just in case there is some more market weakness in store for us. But other than that, uh, that's just been my approach. I typically I usually take more risk when I see market strength, but because of the volatility in the markets and potential shift in investor sentiment, I'm just playing it more safe to protect my own capital and shifting into these blue chip stocks. But that being said, I know you mentioned to me earlier you were looking at this company called Converge Technology Solutions Corp. It's an OTC stock, so it's ticker CTS.V. So would you like to discuss more about it right now?
Yeah, so it's a Canadian company building a platform or regionally focused hybrid IT infrastructure providers that they basically deliver best of breed solutions and services in the US. So the solutions provided include multi-cloud solutions, blockchain resiliency, managed services, enabling companies to address the business and IT issues that public and private sector organizations face. So it has two reportable segments, basically in the US and Canada, and the majority of its revenue is generated from product sales in the US. So they're essentially like an IT company, and I will provide links to the company company site and more information about them in the description. So be sure to check them out. They are a stock that I see going up just because they're a tech company and they provide cloud solutions. So and hybrid and IT cloud solutions, and it's just something to look out for because any tech company like this has a potential to grow, and it's only trading at about like $6 on the TSX right now. So be sure to take a look, and as always, do your due diligence and make sure that you know your risk tolerance, as we always say. Moving on now, I wanted to bring up crypto. I know Deepak, you recently set up a crypto portfolio as well. Well, not recently, a few months ago, that is, but just wanted to talk about that and for my end and my portfolio. So I wanted to talk about Bitcoin and Ethereum. So those are two coins to look out for. Bitcoin is now at 71,000, over 70,000 Canadian. So it is booming. So be sure to keep an eye on Bitcoin. I did increase my position in Bitcoin recently, and it's continuing to grow, and the Tesla deal definitely may have something to do with it. And yeah, keep an eye out on that. Also keep an eye out on Ethereum. Also with DogeCoin, even though it is a meme coin, keep an eye on it. Keep an eye on it. Keep it on your watch list. It could go up and you could make profit, but again, it is a meme coin, so do your own due diligence and know your risk tolerance before investing into anything. And that's why we had the position segment today, so our newer investors know what they're going into and how to have a position. And also, other cryptocurrencies to look at are Ripple and Stellar, so be sure to keep an eye out on those. And Deepak, any updates from you on your crypto portfolio?
Yeah, I mean, I haven't really changed much of my portfolio balance, but I have a little bit of all the altcoins as well because I believe in the bull market where Bitcoin continues to skyrocket in price. I think the other altcoins are also going to appreciate in value. But again, sentiment can shift. If Bitcoin continues to outperform, maybe capital leaves these altcoins and goes flowing back into Bitcoin, like you said, you added more Bitcoin. So if that happens, these altcoins could go down in value. But I think for now, as Bitcoin goes up, I think these other altcoins are going to follow suit. Obviously, with these smaller market caps, you could see more growth with these smaller altcoins. But if you want to have crypto exposure and you don't want as much risk, then yeah, I think Bitcoin and Ethereum are probably the safer bets overall. But yeah, like you said, Ripple's a good one, Stellar's a good one. Link is another one that I'm invested in. But again, it all depends on your risk tolerance, how well you want to build out your crypto portfolio. But yeah, just do your own research. Again, like there's a lot going on with the crypto market. A lot of it might be FOMO, so just be careful about that. And like I said earlier, position sizing is very important, and make sure that you have a stop loss in mind in case there is a correction where you close out your account before basically losing all your money, because
Yeah.
you don't want the incidents of past years where Bitcoin skyrocketed and then corrected steeply, where people really lost their homes because they mortgaged them to actually buy more Bitcoin. So again, you don't want to have that situation. Have your stop losses in place. Um, but hey, it is a bull market, and it's not a bad idea to get some crypto exposure. That's for sure.
Yeah, Elon Musk tweeted, I'm reading it right now, so it's Sunday right now, and the 21st, and Elon Musk tweeted like a few hours ago, Dogecoin again, something about Dogecoin. So definitely keep an eye out on Dogecoin, and it is a meme coin, as we said, but yeah, I just wanted to point that out just for the memes of it, as the memes are still going, and it went up to 10 cents, but then it's about 7 cents now, and this is Canadian pricing. So it could go up as Elon is still tweeting about it. But yeah, that's crypto. And you mentioned losing your money, and next week we want to talk about crypto wallets and how keeping all your coins on trading platforms such as Index and Coinbase and others. is not the greatest idea. You should like if you are investing into crypto, you should know how to set up your own wallet where you can where you can store your coins securely. Like it's like a wallet basically. Think of it as you managing your own cryptocurrencies, like your coins, right? If you leave it on a stock exchange, if you leave it, sorry, excuse me, if you leave it on a exchange, right? It's basically like leaving your all your money in your bank account on a stock exchange, and that's or like in like your investor's edge account, right? That's not the smartest idea. So that's what we want to look at next week. We're going to talk about crypto more next week, and we're going to talk about how to set up your wallet and how to transfer your coins in there, and what the best wallets are, either that's going with the app or a hardware wallet. Again, we will get into we'll talk about this more in depth in episode 10 next week, as crypto was a topic that many of you guys, our viewers, wanted to hear more about. So we'll be sure to have that for you guys next week. And for this episode, that about wraps it up for this week. With that being said, thank you for listening to our episode. We want to thank you once again for all the love and support you guys are giving us. For those of you streaming on Spotify or Apple Podcasts, be sure to follow us and give us a rating on Apple Podcasts. And for those of you guys listening on Google Podcasts or YouTube, be sure to like the video and subscribe to our YouTube channel. Also, be sure to check out our social media, so Instagram and TikTok. We weren't really active on TikTok this last week, but we'll be sure to make more content for you guys there. And that's it for me. Is there anything you would like to add, Deepak?
No, that's it for me as well. Thank you so much for joining us, and we'll see you again next week.